The pound looks familiar, coins in a pocket, a number on a screen, a symbol of British stability. Yet its true value is decided elsewhere in the quiet spread between bid and ask, in late-night futures trading, in a policy speech that shifts expectations by a single phrase. One morning it's £1 buying $1.27. Weeks later, it's $1.20, and nothing in the supermarket feels the same anymore. Exchange rates are the economy's most sensitive seismograph. They register fear before headlines do. When confidence thins, the pound doesn't collapse with a bang, it leaks, steadily, through capital outflows, rising risk premia, and the global price of dollars. Tonight we follow the hidden forces that press down on a currency: debt, rates, energy, politics, liquidity, each one a lever. And we ask the unsettling question: if the pound is under pressure, what, exactly, is pressing? The first sign is rarely a dramatic plunge. It is a cluster of small numbers drifting the wrong way. Gilt yields climbing faster than peers, mortgage rates repriced overnight, and the pound softening even on good domestic data. In markets, the warning light is often CDS, credit default swap spreads on banks, and the sovereign widen an insurance premium that quietly says risk is rising. Liquidity thins as well. Dealers quote wider spreads, corporates shelve bond sales, and pension funds feel margin calls when rates jump. You may also see the forward market tilt higher hedging costs, fatter implied volatility because traders pay up for protection. For the UK, a persistent current account gap means the country must attract foreign capital to fund its spending. If that inflow hesitates, the exchange rate does the adjusting. On the street, it arrives as imported costs, fuel, food, medicines priced in dollars turn more expensive before wages catch up. None of this proves a crisis, but together, they reveal a single story: confidence is being rationed. Exchange rates move on a simple principle. A currency is a claim on a country's future income, and markets reprice that claim when the future looks riskier. The quickest channel is the interest rate differential. If the Bank of England is expected to cut while the Federal Reserve holds, money chases yield selling pounds to buy dollars. But rates are only the surface. Beneath it sits the dollar plumbing, FX swaps, repo and short-term wholesale funding. In a shock, lenders demand more collateral, haircuts rise, and leveraged positions are forced to unwind. A carry trade borrowing cheap in yen or francs to buy higher-yielding assets can reverse in hours, draining liquidity from risk currencies. Add the terms of trade effect. If energy priced in dollars jumps, Britain must send more pounds abroad for the same barrel or cargo, widening the external funding need. The exchange rate becomes the adjustment valve, fast, forward-looking, and unforgiving. Then there is the force that cannot be graphed directly: credibility. Currencies price not only today's rates, but the story investors believe about tomorrow: whether a government can fund itself without destabilizing inflation, whether a central bank will do what it says, whether rules will survive the next political shock. When credibility wobbles, the risk premium rises. Foreign investors demand higher yields to hold gilts, and if yields jump too far, the stress spills into pensions, banks, and mortgages. In 2022, Britain saw how quickly this can accelerate. Gilt prices fell, yields surged, and parts of the pension system faced urgent liquidity needs, forcing rapid selling that fed the cycle. The pound does not fall because the country is poor. It falls because the market fears a loss of control. Exchange rates, in that sense, are a referendum that never closes, counted every second, with no appeals process. To see the pattern, look beyond Britain. In 1997, parts of Asia learned how fast confidence can evaporate. When foreign currency debt met a sudden stop in inflows, reserves drained defending pegs, rates were pushed sharply higher, and the IMF arrived with emergency funding alongside tough conditions. The currency became the shock absorber, and balance sheets cracked where liabilities were in dollars, but income was local. Argentina shows the loop. Devaluation lifts inflation, inflation lifts rates, and higher rates crush growth, tempting governments back to money printing and controls. Greece, locked into the euro, could not devalue at all. Adjustment came through wages, taxes, and recession. Turkey's lira illustrates credibility risk when politics leans on the central bank. Venezuela is the extreme end, multiple exchange rates, shortages, and hyperinflation. Different stories. One lesson: exchange rates punish weak foundations and confused policy. The IMF is often framed as a rescue, but in currency crises, it is also a signal the country has lost access to normal financing. In 1997, IMF programs sought to restore confidence by tightening budgets, raising rates, and reforming banks. Painful steps aimed at stopping capital flight. Critics argue some prescriptions deepened recessions. Supporters say the alternative was a collapse in payments. Argentina's repeated programs show how difficult it is to fix a currency problem without fixing the state's credibility. Once people expect devaluation, they convert savings to dollars, firms preemptively raise prices, and the central bank burns reserves just to slow the slide. The exchange rate becomes psychology made visible. The key indicator is reserve adequacy versus short-term external debt. When the market believes reserves are insufficient, even a strong rate hike can fail because the question shifts from what yield to will I get my money out? That is the moment a currency stops behaving like a price and starts behaving like an emergency. For Britain, a weaker pound is not just a market story, it is a cost of living mechanism. Sterling's side raises the price of imported energy, food, and industrial inputs, and because many commodities are priced in dollars, the pass-through can be fast. Inflation expectations drift higher, and the Bank of England faces a dilemma: raise rates to protect price stability, or ease to cushion growth. Higher bank rate lifts SONIA and swap rates, feeding into mortgage quotes within days. When fixed-rate deals reset, monthly payments jump, squeezing spending and lifting arrears risk. House prices soften as affordability bites. Developers pause, rental pressures intensify. In markets, foreign demand for gilts matters. If investors demand a higher yield to hold sterling assets, public finances tighten. A weaker pound can help exporters in theory, but only if capacity exists and global demand holds. For many firms, it instead raises hedging costs and input bills, squeezing margins. The currency is not a sideshow. It is the transmission line from global finance to British kitchens. In a global panic, sterling can fall even if Britain has done nothing new. Money sits in a hierarchy, and at the top is the US dollar, the settlement currency for trade, debt, and commodities. When investors rush for safety, they scramble for dollars, and that scramble tightens financial conditions everywhere. Banks hoard liquidity, funds unwind leverage, and the cost of swapping pounds into dollars jumps in FX swap markets. You see it in cross-currency basis, in wider bid-ask spreads, and in implied volatility as protection becomes expensive. When the VIX and the bond market move index spike, margin calls for selling across portfolios, including sterling assets. Even healthy countries get dragged lower because global investors de-risk together. For sterling, part of the pressure is imported carried on the same tide that lifts the dollar index and squeezes world credit. It is why sterling can feel like a risk asset at precisely the wrong moment. Britain's own profile matters too. The UK typically runs a current account deficit. The country buys more from the world than it sells, and the gap must be financed by attracting capital. When foreign investors are eager, sterling is supported by inflows into gilts, equities, direct investment and corporate credit. When they hesitate, the exchange rate does the adjusting often faster than trade volumes can respond. This is why the pound reacts to growth forecasts, political uncertainty, and sudden shifts in global risk appetite. Watch the numbers that describe the dependency: the current account balance, net investment income, the net international investment position, and the share of gilts held overseas. In calm periods these are footnotes. In stress they become the plot, because they tell you how much confidence the UK must continuously import each year. In effect, sterling is priced like a confidence asset, not a commodity currency. Fiscal credibility is the next lever. Markets ask a basic question: can a state fund itself without forcing either inflation or a sudden squeeze on households? Debt to GDP, The maturity profile of gilts and the auction calendar all matter, but so does the story around them: fiscal rules, independent forecasting, and a plan that survives elections. If investors suspect fiscal dominance, that policy will lean on the central bank to keep borrowing cheap, the risk premium rises. Gilt yields can jump relative to peers, while sterling weakens at the same time. Higher yields no longer look like a reward, but like a warning. Bid-to-cover ratios at auctions, the spread to German bunds, and sovereign CDS are the quiet indicators of that doubt. And because the UK has inflation-linked gilts, higher inflation can feed directly into debt servicing costs, tightening the loop. The Office for Budget Responsibility and respect for its role helps hold that line. Housing turns currency moves into everyday stress. A weaker pound lifts inflation. Inflation pushes up bank rate expectations. And those expectations feed directly into swap rates that shape fixed mortgage pricing. When deals reset, a family's monthly payment can jump by hundreds of pounds, shrinking consumption and raising arrears risk. As affordability tightens, house prices can soften, equity buffers thin, and mobility declines. People stay put because moving is too expensive. Construction slows, hitting jobs and tax receipts. Commercial property adds another layer. Rising yields lift cap rates, valuations fall, and refinancing becomes harder. Property is also a confidence barometer for foreign capital. If overseas demand pauses, lenders become cautious and liquidity retreats. In the UK, housing is not just an asset class. It is a transmission mechanism for exchange rate shocks. The banking system sits at the centre of the transmission. UK banks are better capitalised than before 2008, but they still operate in global funding markets. In stress, short-term wholesale funding can reprice quickly, and the market watches bank CDS as a proxy for system strain. Liquidity ratios LCR and NSFR are designed to prevent a classic run, yet modern runs are digital. Deposits move at the speed of an app. Sterling funding stress shows up in repo rates, in swap spreads, and in the gap between risk-free overnight rates and unsecured funding. If banks pull back, credit to firms and households tightens, growth slows, and the currency faces a second-round hit. The Bank of England's stress tests and ring fencing help, but in a shock, confidence still depends on transparent backstops and good collateral in liquidity operations. In a squeeze, collateral quality and reliable access to both facilities can decide who survives. For companies, exchange rates are a margin story. Importers pay more for components, packaging, fertilizer, fuel often priced in dollars, while exporters may gain competitiveness only if demand is there and supply chains can respond. Large multinationals hedge with forwards and options. Smaller firms often cannot, or they hedge too late, after prices have moved. That raises the risk of a profit squeeze. Costs rise now, sales prices rise later, and cash flow turns fragile. Look at working capital needs. Inventory becomes dearer in sterling terms just as banks grow cautious. In bond markets, sterling spreads can widen and new issuance can stall. Investors demand compensation for uncertainty. When liquidity dries up, even good businesses struggle to refinance. In a currency shock, the problem is not only the level of the pound, it is the speed of the move, which overwhelms planning and contracts. For households, the pound's decline arrives in pieces: a higher supermarket bill, pricier holidays, a dearer boiler replacement, and then weeks later an updated mortgage offer. Inflation indices capture averages, but lived inflation is personal. Families feel the items they buy most. In the UK, energy and transport costs can swing quickly, and imported food and household goods quietly reprice. Real wages can fall even when pay rises, because prices are running faster. Confidence surveys dip, spending slows, small luxuries disappear first. Meanwhile, savings earn more only if deposit rates follow bank rate, often with a delay, so cash can still lose purchasing power. Currency moves also shape job security. Firms facing higher input costs or weaker demand freeze hiring. The exchange rate is a financial variable with social consequences. And because the UK imports many essentials, the pass-through can linger longer than people expect. Turkey shows what happens when credibility breaks in slow motion. Persistent high inflation, large external financing needs, and political pressure on monetary policy combine to erode confidence in the lira. Rate cuts in the face of rising prices signaled to markets that inflation would be tolerated. The lira weakened, imports became dearer, and inflation accelerated an exchange rate pass-through loop. As dollarization rose, authorities leaned on regulations, reserve requirements, and selective controls to slow the outflow. But once households and firms prefer foreign currency, the domestic unit becomes a hot potato, and reserves are spent merely to buy time. Turkey's lesson for the UK is not that outcomes are identical, but that expectations matter. An independent central bank, clear communication, and a coherent fiscal stance are not technocratic details. They are the foundation a currency rests on. Greece offers a different warning because it could not devalue. Inside the euro, the exchange rate was fixed, so adjustment came through austerity, recession, and what economists call internal devaluation, wages and prices pushed down to restore competitiveness. Bank liquidity depended on the euro system, and deposit flight became a political drama peaking in capital controls in 2015. Sovereign bond yields and CDS screamed risk, yet the currency could not move to absorb it. For Britain, floating sterling is a release valve. It allows prices to adjust without forcing everything through unemployment, but it is not free. Devaluation can protect output in the short run while importing inflation. The Greek case reminds us that every regime has a cost, and the cost of flexibility is discipline, because markets will not lend indefinitely to a country they doubt. It also shows how quickly politics and finance fuse when cash machines run dry. Venezuela shows the far end of the spectrum, where institutions collapse and the currency loses its basic functions. When deficits are financed by printing, money supply growth outruns the economy, and prices sprint ahead. Redenominations remove zeros, but not the cause. Multiple exchange rates and controls appear, not to stabilize the system, but to ration scarce dollars. Shortages follow because importers cannot access currency at realistic prices, and a parallel market becomes the real economy. Even in an oil-rich country, production can fall when investment, governance, and incentives break down. Hyperinflation is not mysterious. It is the arithmetic of broken trust. No one thinks Britain is Venezuela, yet the example clarifies a principle. A currency is a social contract. When people stop believing the contract will be honored through stable prices and predictable rules, they find alternatives, and the official rate becomes theatre. So what can stabilize sterling when pressure builds? First, a credible inflation anchor. The Bank of England's job is not to defend a particular level of the pound, but to keep inflation expectations contained, because expectations drive wage bargains, pricing, and long-term rates. Second, functional markets. In stress, the bank can provide liquidity via repo operations, standing facilities, and targeted support for market functioning, while the Financial Policy Committee adjusts macroprudential buffers. Third, coordination without capture. Fiscal policy must show a believable path for debt, while the central bank retains independence and communicates clearly through the MPC. Internationally, swap lines with other central banks can ease dollar funding strains, reducing forced selling. None of these tools is magic, but together they rebuild what a currency needs most: time and a credible plan for what is done with that time. Crisis management is often a choice between bad options. Raise rates too aggressively, and you may stabilize the currency while breaking housing and business credit. Move too slowly and inflation embeds, which ultimately forces even harsher tightening. Quantitative tightening can reinforce credibility, but drain liquidity. Quantitative easing can calm markets, but risks looking like deficit financing. That is why officials watch plumbing indicators, repo fails, bid-ask spreads, money market stress, and the gap between policy rates and market rates. In 2022, when pension funds faced margin calls, tied to liability-driven investment strategies, the response was framed as temporary market function support, not a return to permanent stimulus. The distinction matters: lend against good collateral to stop a fire sale, but avoid turning a liquidity shock into a solvency illusion. A central bank can create money. It cannot sustainably create trust. For viewers, the challenge is separating noise from signal. A daily FX chart is dramatic, but the deeper story sits in a dashboard of indicators. Watch the pound against the dollar and the euro, but also the forward points that reflect interest rate expectations. Track gilt yields across maturities, the spread to US Treasuries and German bonds, and measures of market volatility. Look at bank CDS and funding spreads, not because you can trade them, but because they reveal stress early. Add the real economy pulse, PMI surveys, unemployment, retail sales and business investment. Follow inflation expectations, break-even rates and measures of wage growth. Energy prices matter, especially gas, because they shape both the trade balance and the inflation outlook. And keep an eye on global risk sentiment. When the world goes risk-off, sterling often feels it before Westminster does. Even the trade-weighted index adds context. Personal survival in a currency squeeze is less about prediction and more about resilience. Start with cash flow, build an emergency buffer, and reduce high-interest debt, because rising rates hit unsecured borrowing fastest. If you have a mortgage, know your reset date and run the numbers early. Switching from variable to fixed can reduce uncertainty, even if the headline rate looks higher. Diversify savings across time horizons, instant access for shocks, and longer-term investments spread globally, so your future is not tied to one currency alone. For big purchases with foreign currency exposure, travel, tuition, imported goods, plan ahead rather than react in panic. Keep insurance and direct debits reviewed, and stress test your budget at higher bills. At work, invest in skills that remain valuable in downturns, and keep employability high. These steps do not defeat macroeconomics, but they reduce its power over your household and give you choices when others are forced to react. In the end, the pound is not merely a unit of trade. It is a verdict on Britain's institutions, and on the stories we tell about the future. Exchange rates appear technical, yet they are human. They measure confidence, coherence, and the willingness to bear short-term pain for long-term stability. When sterling is under pressure, the question is not only what is the pound worth, but what do we, collectively, stand for: credible rules, honest budgets, independent policy, and a realistic view of our place in the world. The hidden forces behind exchange rates are not secret. They are easy to ignore until they become unavoidable. If we watch them calmly: rates, debt, liquidity, risk premia, and respond with discipline, a currency can recover. And so can the lives that depend on it, because stability is not a gift from markets. It is the outcome of choices, repeated over time. A stronger pound begins with stronger balance sheets, national and personal.